My name is Sandeep Dahiya. I am Professor of Finance here at McDonough School of Business, and thank you for being here. I am delighted and honored to be chairing this panel. Dan was, of course, was with us at an event yesterday, which is our Markets in the Hill series, where we take burning issues that are important to regulators and to industry practitioners. So I just thought I'll mention a little bit about that. There's other work that the center does, the Center for Financial Markets and Policy, which is hosting this. We also do this outreach with our thought partner and partner in many ways, the Milken Institute, some of whom are here as well. Today's panel, I'm delighted, but what I'm going to do is, instead of introducing each of you, I'll give you opportunity to say a little bit about yourself and your firm a little bit, and then we are going to get into some discussions. Sapna, would you like to start?
My name is Sapna Patel. I work at Morgan Stanley. I oversee our market structure and liquidity strategy for the Americas. Been at Morgan Stanley for 11 years. Prior to that, I spent 5 years at the SEC. And Steve Luparello told me I can bash the SEC because he's left, so.
I'm Ira Shapiro. I'm with BlackRock, which is a large asset management firm. And I am with the ETF side of BlackRock, the iShares division, as the head of product strategy and research.
I'm Dan Draper. I'm the global head of PowerShares, which is owned by Invesco.
Okay, I'm Andy Bruxton. I'm head of U.S. equity trading at Rowe Price, and we are a client of Morgan Stanley's, not these other guys.
Thank you very much. We've had a fascinating panel before us on the regulation in the morning, where we saw almost a worm's eye view of the technology and the innovations that are happening in this market. So I thought it's fitting that we should have this panel where we get to see what is it all about. It's after all, the panel that I have here are the investors who are on the other side, and everyone invokes them that, it's for your benefit that all this thing is happening. So what I would like to ask to all my panels is, what is it about the markets that is working, and what are some of the challenges? And talk a little bit about how those challenges can be addressed. And this is a question that I would like every one of you to respond. Andy, I know that Rowe Price has, after pushing back against high-frequency trading, is kind of dipping his toes in that a little bit. Maybe you can start a little bit about where you see the challenges and what you think is working well.
Right. Well, great. Well, first of all, we're delighted to be here. So thank you, Rena, for that very kind invitation. I think when we step back and look at the markets, it's important to remember a number of things. One, the markets open at 9:30 and they close at 4 o'clock, and trades settle. And I'm delighted that we're moving to T2. We'll get to T1 pretty soon, and that'll be good. And when people think about counterparty risk, everybody's interested in shortening the settlement cycle. So that's a positive development. But in between those hours of 9:30 to 4 o'clock, there's probably way too much intraday volatility that's happening, and it's really not necessary, and probably not really in the interest of people like us who represent longer-term investors. Now, we certainly acknowledge markets to work well need all kinds of investors. You need all kinds of people with different time frames, different goals, different outlooks on things. But I do think that we are probably, without a doubt, somewhat dysfunctional. That's a pretty strong word, but we've got 12, 13 exchanges in this country. We've got 50-plus dark pools. Boy, the complexity is enormous. Everybody earlier talked about fragmentation. We are way past competition. We're certainly innovating, but it seems to me we're way past competition when you have that many places to go. So just trying to get the job done every day, costs are up. They really are, and we're not really focused on that. We're focused on a lot of other things. So I hope at some point we'll get back to that kind of focus. Markets work, investor views and sort of confidence, I think, have been challenged, but we were able to get the job done, but maybe not as well as we really would like to.
Dan?
Yeah, well, I think just, up front kind of acknowledge, I've spent about 17 years of my career outside of the U.S., so I came back about 3 years ago to take over the PowerShares business. And so coming from the outside, particularly Europe, and I spent a few years in Asia, I mean, this is just nirvana. I mean, I know it sounds crazy, but when you come, and I know a lot has been made about the capital markets and this great asset that the United States provides, but it's absolutely true. And I think in my narrow world of ETFs, I couldn't think of an area where it's more beneficial to have one regulatory regime, one clearing settlement system. Yes, there are a number of exchanges, but I do think in aggregate, they all do work well together. One currency, I could go down the list, but you do have this great capital markets. And as we've, as a country, moved to much more of a service-based society, we financial services, we're in the midst of this. And I think about ETFs, and I mean, Debbie, who's going to speak next, can correct me, but I think about 73% of the ETF AUM, if you will, is manufactured in the United States. And by that, I mean listed and pretty much managed here. But if you actually look at the holdings, the last data I saw, only about 58% was actually held in the United States. So exchange-traded funds, and it's not just the actual products, but the exchange, the liquidity, and the environment, this is a fabulous export to the rest of the world, and they're coming for all of those great elements that I mentioned earlier. So I do think that there are a lot of great things that we focus on. What I would also, just a couple other quick things, is I'd say that most of the discussion today has been, I mean, for me, has been phenomenal. I think this is a great conference. But I would define a lot of it as really tilted toward the supply side, if you will, if you're thinking in economic terms. And I think as we think forward about the demand side of the equation and what customers and preferences, we can only push the strings so far with the supply side. And I do think there continues to be a healing process, post credit crisis. And we have a huge demographic, obviously, shift with 10,000 individuals in this country turning 65 every day. Clearly, those people are going to be, in many cases, more risk averse. And the wealth transfer that's going to happen to the millennials, and it will happen, is going to be happening later than maybe in previous generations. So I think there's a lot of the demand side, and I know we're going to beat ourselves up and we're going to get better, if you will, supply side solutions, and we're going to work hard on that. But I think we also have to appreciate that, that there is these bigger kind of macro factors that are happening. And then just let me end on a very specific element. I think August 24th is clearly very topical. And I do think that a lot of the coordinated work among exchanges and regulators has really been beneficial for that particular instance. I think we've addressed it well. Just one further ask, I would have is if you look back to that day, not only when the equity markets opened, limit down, but you also importantly had limit down on futures. And I think that's something where perhaps, if we look to CFTC, SEC, and obviously the exchanges, among others, just to coordinate a bit more, I think if we could get those future regulations aligned a little bit better with the cash equity markets, that's just so crucial to market makers. I think that's another element of this really good path that we've been on, at least correcting that event.
Well, thank you, Dan. Ira, do you see any challenges? Of course, you can also talk about what is working well, but both.
So I find myself in large agreement with both Andy and Dan's remarks. To put some context around it, I think there's been two huge developments in U.S. equity markets over the last decade to decade and a half that have been hugely beneficial. That being said, they've changed markets in ways that are not always beneficial. There are some side effects from these good developments. So the two big macro trends I want to highlight, one is Reg NMS and the changes to market structure that it brought about. I view it as generally very positive. It's made markets faster and cheaper than they certainly were when I started my career. And I find myself amazed at how quickly and cheaply you can move exposures around in today's market. A lot of that is the consequence of technology, but a lot of it is the consequence of a more competitive market environment than we used to have. The other rise, which is dear to me because I've spent my career on it, is I think the rise of ETFs have really changed markets. It's bringing all kinds of exposures that individual investors and institutions used to have a hard time trading into a very easily executable trade on U.S. public markets, generally taking things from non-transparent difficult to price OTC environments and bringing them into transparent exchange environments is a terrific development. That being said, as a result of some of the competitive changes in markets, and in particular some of the change in capital rules that Commissioner Giancarlo highlighted, there is a fragility in today's markets that I think is different than what was historically the case. In periods of volatility, for whatever reason, capital can flee. And there is sometimes events where there is no buyer of last resort in the way that there used to be in the old specialist system. And I think we have to come to grips with the implications of that and maybe think about some tweaks to the system here and there to address it.
Thank you. Sapna, would you?
Sure.
Sure.
In terms of what works well, I think we've heard it on prior panels and we hear it all the time. Our U.S. markets are very resilient, very efficient, the envy of the world. And that makes us want to be very careful about what we would necessarily tweak or change because we don't want to break what already works well overall. Certain areas where we could do better, and Dan actually touched on one of the ones I was thinking about, you can't look at asset classes in isolation. And I think regulation does that a lot. And August 24th is probably the perfect example. The underliers certainly impacted ETFs that day. You need to think of that interaction. The future markets impact how equities trade, and you need coordination among the SEC and the CFTC, among the other government agencies when it comes to that. It's much easier to say, much harder to actually do, given different agencies, different initiatives and timeframes. But it's certainly something that we could probably do better. And when you kind of look at it globally, a lot of us trade globally or have businesses globally. You have to deal with regulators in other countries that have similar regulations and there's overlap. So that makes it very difficult, and that's one area where we could improve. The second, I would say, is, and I understand what Steve Luparello was saying in terms of regulators not wanting to be proactive about driving change in the marketplace, but I do think that regulators need to be proactive about addressing gaps in regulation or unintended consequences of regulation. We've seen a lot of reactionary immediate action from the regulators in response to a lot of the market volatility events. But we've been having conversations since the last big fundamental change to our equities markets, Reg NMS. We've seen conversations about pilots or discussions among the SEC's Market Structure Advisory Committee, but we haven't seen change necessarily. And I think just having worked at the SEC, that's one of my biggest frustrations sitting on this side. Chris Kincannon alluded to what the behind the doors conversations about the need for Reg NMS was in the first place. And a lot of it was to automate the marketplace, to automate the New York Stock Exchange, because we had an application for NASDAQ, a very automated venue, to become an exchange, and how did the two go hand in hand? And I say we, as the SEC, maybe I should give a disclaimer. We thought about it, we proposed it, we had an industry hearing on Reg NMS in New York, reproposed it, adopted it, and fully rolled it out in 4 years. A lot of people had issues with aspects of it, a lot of people loved other aspects of it, but we threw this fundamental change into the marketplace and we all reacted. Business models changed, trading strategies changed, and we haven't done anything to then address it. So I think that's one area where we could do better. Pilot program, you don't need pilot programs to tell you certain things that don't work. Does the order protection rule still protect retail investors who are providing price discovery on the exchanges, or are we protecting someone else? 30 mils, as Chris Kincannon pointed out earlier today, very outdated, doesn't make sense when the average cost of trading off exchange is anywhere from 0 to 10, and I don't think you need a pilot to tell you that. So I think that's another area where we could do better. And then the last area I would list is, and we've heard these words before, we have a very one-size-fits-all model when it comes to the way we look at our marketplace. Illiquid stocks certainly trade differently than liquid stocks. Low-price stocks trade differently than high-price stocks, yet we have the same tick size or the same access fees, and that's going to drive different behaviors. It's going to drive certain flow off exchange. It's going to drive other flow on exchange. And while we don't want more complexity, as Andy alluded to, we're overly simplifying our marketplace too. There's got to be a delicate balance.
Thank you. I mean, these issues of fragility and regulation, whether it should be proactive or should wait as it plays out, it's a very interesting issue, and hopefully this will come up again. What I wanted to also bring up is that the earlier session today, as well as popular press keeps bringing up, it's almost a nuclear arms race in technology that you see on the broker side. Sapna, I guess you sit probably on both sides because you have clients as well as proprietary trading, but the rest of my panel is definitely people who are putting their money in the market. And I would be curious if you could share your thoughts on that. Like, are these brokers or technology firms, exchanges, they're investing in this just to keep up with each other, or do they actually listen to the clients, to the investors, and that is driving this? How does the concerns of the investors kind of get heard, communicated, and baked into this the incredible technology that we are seeing playing out in exchanges as well as broker these things? And here, I would, anyone who wants to take it first is.
I think Andy really wrote the
Now,
Andy, go
so
ahead.
maybe I'll try and kick us off a little bit. So I think that if technology supports innovation and innovation brings something to a client, that's a great thing. So if an ETF is an innovative product, which it certainly has been, and you bring that to a client that's been unable to participate prior, that's great, and technology should support that. If the marginal utility of a technology spend is very minimal, like it's some nanosecond improvement, I'm not sure that's so good. And by the way, that's really expensive because then everybody has to do it. And one of the things that I think is important for a trading desk or for investors or ETF providers or mutual fund companies, anybody, is you're trying to, it seems to me, minimize the arbitrage that exists within your universe. Because that suggests that somebody's getting a better deal on something. So if you not a one size fits all, but if a technology spend gives you an advantage that's really maybe not so much in the public interest, how do we slow that down? Because of course you can never say, oh my God, don't innovate, don't improve, or don't try something new, because America's sort of built on that. But at some point, maybe we've gone a little too far. And I guess what always bothers me is we never just pause for a while and kind of get a lay of the land. Can we just take a timeout? Go to the timeout chair and let's see how we're doing for a few minutes. And I think some of the innovations, some of the things that have happened to the market, we don't get a chance to step back and say, okay, how's this really working? Think Reg NMS, been a long time. Mm-hmm. Think my favorite pet peeve, dark pools, established solely for the purpose of block trades. And yet today, smaller trade size in the lit market. And now we got 50 of them. How do we put that genie back in the bottle? How about a minimum trade size in a dark pool? You really want to talk about displayed liquidity and increase sort of comfort level and things in the market? Let's try that for 6 months. So technology always sounds great, but we have to pay for it. It's like market data. We got to pay for all this market data. We create the data, for God's sakes. Where are these people that are selling all this data? I was on that. I'm the other person in the room that was on that commission 15 years ago with Don, and Bernie Madoff was with us. We were one of like 37 people on that thing, talking about market data. Back then, it was a $500 million business that was resold into like $6 billion. So today it's probably like a $6 billion business resold into maybe $60 billion. I don't know what the numbers are, but it's big. And investors pay for that. And I'm not sure we're getting a lot of utility out of that spend. So
I'm not keeping score, Andy, but I'll put you on this thing that investors' wishes are not getting listened to too well, if I can take away from that.
Well, but...
Well, Ed, other thoughts? Yes, go ahead.
I can give a sell-side perspective
please
on
do.
behalf of the buy
Because
side.
you guys you got to pay it.
It is a technology's arms race, and in order to stay competitive, you need to have the latest technology. You need to have direct feeds to trade effectively in this marketplace. You need to connect to every single exchange that's out there. You need to,
Do you really have to, or is that a regulatory requirement?
It's a regulatory requirement,
Right.
exactly. It's a fair point. Exchanges offer products, and they have the ability to charge, whether it's port fees or market data fees, and we must pay, right? And so that's been a huge sell side and even a buy side concern. If an exchange offers a 40 gig line, does anyone really need it? But the minute that they offer it, even though a 10 gig line is sufficient, we're going to have to buy it, because if we don't buy it, our competitor is going to buy it, and we're going to be at a disadvantage. And so you have to basically kind of keep your technology evolving. We had to do an overhaul at Morgan Stanley of our entire technology infrastructure back in 2011, because you can only put so many Band-Aids on old technology and take out so much latency until you're not competitive with the next guy that's out there. And hopefully, to the extent that we're actually putting money into this and the cost of trading is going higher, our buy-side clients benefit from it because they leverage the same technology that we offer to interact in the marketplace. So hopefully there's that added benefit to it. But the cost of trading is going up, and there are people who can afford it, dedicate the resources to it, and there are other players who are getting out of the game as a result.
Yeah, I mean, it kind of captures the spirit of what I was trying to get at. Is this economists call it, like if you're in a crowded event and you go on your tippy toes, you can see better. But then everybody notices it and everybody's on tippy toes. Now nobody can see better and everybody's uncomfortable. So
But I think if you bring it back to basic tenets, I mean, I think you look at incorporation or PLCs in the UK, I spent a lot of time, and you look at kind of the common law behind it. And capitalism is embedded with conflicts of interest, right? And this is what I think the exchanges and ways to try to smooth, but get people with different pieces of information, different goals and objectives in a way to transact, as best possible. And like in the UK, I know that there was a court case in 1896, Solomon versus Solomon and Company. So this little bootmaker in Whitechapel, East London, basically had incorporated his company, and it became insolvent. So he was sued, basically, by the shareholders. And this was crucial because this common law obviously came during the Gilded Ages here in America with all the great corporations that came up out of all that. But that protection basically for him to incorporate, and we kind of face those same conflicts. So I'd say no matter how much technology you get added, ultimately the fiduciary rules, which back in those days was a prudent man approach. Now we've added diversification, modern portfolio theory to have a prudent investor rule. We really evolved. These are tenets which all of us as fiduciaries certainly on the buy side, have to maintain. Now, I think if technology comes in, exchanges or otherwise, and can really help get through these frictions and really help these, and these are embedded conflicts of interest between shareholders, management, and other stakeholders involved, then I think that's helpful. But where you get, as Andy said, that kind of diminishing area of kind of return, and actually maybe it creates noise, additional noise, or makes it more expensive to transact, that's where it goes too far. But we do seem to be in a period now where the technology's coming, but then I look as well at corporate governance. And I think where you're now getting, hopefully, more diversity on corporate boards. And we need, more women, more other people with diverse backgrounds to ensure that fiduciary standard is there, proxy access, that's evolving, safer pay. So I think that, again, as I kind of divide the world between supply and demand, I think on the supply side we've talked a lot, but as I would put more on the demand side, on that fiduciary standard to build trust, to bring investors back in after something like 2008, I think there is innovation. It gives me kind of a feeling, but I think having them both really support, you got to have the confidence for investors alongside the technological innovation, better access to information.
Sure, Dan.
Sandeep, just staying with that for a second, though. So I agree 100% with that. But what you're talking about is where the ecosystem has the money to do good things as well, right? But when the money keeps getting siphoned off on a big tech spend, and you have to connect to more and more venues to offer a product that can compete, and you have to pay more for data, and the data doesn't seem to have any relationship to the cost of living or anything else. Price increases in that business no bounds. And we're paying for that. And then everybody that feeds at the trough, so all the vendors involved with delivering order flow and delivering execution, all those people are raising fees because they're all seeing this gravy train and they're all trying to stay on it. And yet, as we look at it, that's siphoning money away from good things like corporate governance and proxy and other things, as well as perhaps the money that's left over by the time It's sort of like, think of the analogy of the Colorado River. Everybody's siphoning the water off. By the time it gets to Morgan Stanley, they're getting maybe this. And yet we value their product. We want to pay for their research or what they're doing to help us in terms of investing money on behalf of our clients. And so all these people are stealing water as it's going by. And we got to, you got to keep the water in the river, so to speak, or the ecosystem. And I'm not sure that's getting a lot of play. A lot of people are starting to complain about it because there is no price sensitivity. What is it? It's inelastic or something, right, in terms of what's being charged for market data. And I don't know whether they have to get approval when they raise their prices. I'm guessing not, right? Do you
No,
know?
they have to get approval.
The exchanges do?
Mm-hmm.
Who gives them the approval? They don't
The
ask
SEC.
us. They ask you?
The SEC.
The SEC gives approval.
Yeah.
Sounds like a new order type. How's that work?
Yeah,
Page
so
67 of the filing, it's in there somewhere.
it seems to paint a picture of a utility that has all the incentives to gold plate its, because it can charge whatever it charges, and why not have the best plant? Why not have newest plant? And it keeps going. I would like you to just respond. Does it drive technology spending even at the client side, that this sort of relentless, we can call it innovation or investment or whatever it might be? Do you think it feeds into a lot of technology and investment spending on the investor side as well?
Sure. So it's a cost, as Andy and others have pointed out, that are absorbed by the buy-side firms. It's part of our cost base. It ultimately gets priced into the products. To the extent that the end users of T. Rowe Price mutual funds or Invesco PowerShares ETFs are not getting any utility from that increased cost, it's just a tax on the system. So I find myself largely in agreement with Andy, but I think the issue is the exchange business model is one that's been in evolution, over the course of our careers. They no longer make money off trading per se. They've really become data providers. And I think there's a lot of inherent conflicts built into the model that they try and manage, but I don't know that they've always done it successfully from my point of view.
If I could just add, a competitive dynamic, this is where Andy's, this high cost of data means increasingly scale matters, and it matters tremendously. Yeah. And I think that's where, as an ETF business, I can look across whether it's portfolio management, marketing, sales, products, capital markets, all these different functions that we have. I want more data, and I will gladly pay more. You're right, we're going to get to some point that it's going to be diminishing returns, but we're very data hungry, and it's very valuable to us when we look at kind of all of those different aspects. And clearly to think about if we can increasingly negotiate more fixed prices on our data, then obviously that's the operating leverage that we really want to get through scale.
Just kind of staying with some of the issues that were brought up in the previous topic, and Sapna, you mentioned about differences in how small stocks get traded, how large stocks get traded, and you mentioned unbundling of research. There's this big, just like there's a technology tsunami going on, there's a lot of regulatory changes that are happening, the tick size pilot, the unbundling of this thing. Then in Europe, they are the MiFID II. So I would love to hear your thoughts about how this is impacting the investors, your business as asset managers. But what are your reactions? What are some things that you see, these regulatory changes, how do they play out?
I'll take a stab at it.
Sure.
And people jump in. We all support, I suspect, regulatory changes that result in better, efficient markets and better access to capital for our end clients.
And Ira, feel free to also talk about the speed as well. It's
Okay.
At the rate of this thing is being brought up.
I think from our perspective, BlackRock's a big organization. We have resources to throw at some of this stuff. But I would observe that not all of the regulation feels like it's completely thought through and fully baked. And in particular, a lot of the reporting requirements that have come out in the last few years strike us as imposing just undue costs, because you get regulators in various markets, sometimes the same regulator for different products, wanting reports on things, but they haven't agreed on what the thing is that they want reported. They're all demanding something slightly different. And so for a company like BlackRock, we have to build, just to use an example, if we're asked to report on the liquidity of our funds, we have to file now for our private funds on Form PF. There's going to be reports under the new mutual fund liquidity rule that the SEC is going to look at later this week. But no one's agreed on what really liquidity in a fund looks like. And so as a result, we find ourselves reporting it about 12 different ways to different regulators. We have to build different systems for each of those reports. None of them really track the way we think about it internally, so it's not actually built on any of our internal systems. It's just added cost, added compliance, added paperwork. And I think there's an awful lot of that that's come out in the last few years.
Okay, so this disparate disclosure that is not fully formed is one of the challenges.
Desire for more information on behalf of regulators, which we sympathize with, but not fully thought through what they're looking for and the cost they're imposing on private firms by asking for the reports that they do.
Sure, any other?
Yeah, I mean, I would, I was hoping earlier we might hear some pretty heated conversation around MiFID II, but I stopped sort of counting when I think it's over 900 pages. The reporting obligations are incredibly onerous, and the changes that are being asked for people to make are unfathomable. And what it's going to do to research or the historic relationship between the buy side and the sell side is, I mean, it's going to turn the world upside down. And I was trying to think, I'm in my 37th year, May Day, so negotiated commissions happened after me, but I think this is going to be the biggest tsunami we've ever seen, probably since negotiated commissions. And the, including things like we might have to list our top 5 providers and exactly how much business we do with each. Now, who needs to know that? I'd tell the New York Fed that, or Treasury, but I don't think I'm putting that on the website. Does that benefit investors or anybody? So that's just one of about 8,000 things we might have to report. And it's not really clear because it keeps getting pushed out to 2018, but the US has been pretty quiet, our regulators, and yet all of us are involved in global businesses, and we're not going to be able to ring fence this. So what are we really going to do? And who's going to win at the end of the day? So if you're of the opinion that the business is terrible and we're all thieves, then maybe you need to keep your money under the mattress, okay? But if you think there's a reasonable value proposition and we demonstrate good value and reasonable returns and reasonable costs, and there's a lot of transparency and a lot of disclosure, why wouldn't you let investors make that decision? Why wouldn't you push that transparency and disclosure to allow for that kind of competition to happen instead of we're just going to take you all out and shoot you? I mean, let's just knock everybody out of the business. Because it's pretty dramatic, right? And we're all sort of like, well, maybe it'll tone down. And the clock keeps ticking. So I don't know how you all feel.
Well, I'll take a little bit from the sell side before I come back to another buy side perspective.
No, I agree with a lot of what you guys are saying. I think in addition to technology costs, regulatory compliance costs are the other things that buy side, sell side firms deal with on a regular basis. And like Andy said, we are global, so it comes from all directions, whether it's MiFID II or things that are going on here. I do agree with Ira. There are regulatory costs that we should have to absorb because that regulation is necessary, and we all agree on that. There is regulation where we do empower the buy side, so transparency-related rules. Mm-hmm. So some of these dark pool disclosures, as well as order routing disclosures. Yes, there's a cost to the sell side to have to produce the information, but it empowers the buy side to make decisions. So those type of costs, probably appropriate. And then you look at some of the regulation just for data collection purposes or just to test a theory. And those type of costs is what you really question. And so let's just take the tick size pilot, for example. The tick size pilot to test the theory of whether increasing the penny tick size to a nickel for liquid stocks, whether or not that actually makes sense, required all of us across the street to do heavy technology lifts, buy side, sell side included. When we're talking about the stocks that actually are being tested making up less than 4% of the volume in the equities marketplace. So we have a mini NMS that we basically implemented for 2 years. It's not even permanent. And we have a lot of work that we had to do as a result of it, but then that brings us to the point, BlackRock and T. Rowe have the resources, right? Not all firms have the resources to basically make sure that their orders and their systems are pricing orders appropriately in nickel increments. So it is a heavy lift. So you got to kind of weigh the regulation versus the benefits to the marketplace, I think.
Sure. Dan?
Well, I'm the ETF guy, so I'm glass half full. I mean, basically, because if you think about, with DOL, obviously, I mean, we can't predict the future, but it does seem in most cases that, ETFs are going to be a pretty significant beneficiary here with that higher fiduciary standard. We're seeing some indications of that already with some of the early announcements from some of the large wealth management firms. And you do see, again, technology filling the gap. I mean, if there are going to be a number of unserved potential clients as a result of this, I mean, it does seem that Robo and other places, hasn't been completely tested, but are willing to step up innovatively to reach out to, kind of mid and small customers potentially. So I think in terms of what's moving, but just more transparency, more data, and I have to believe just that awareness. I mean, some of these comments about, we're having more volatility. Well, I mean, I think we're just aware of it more. Right? I mean, the Great Depression was a pretty big, piece of volatility. We may not have measured it as much data as we do today, but that was much more prolonged. So I think kind of these sharp bursts of volatility we have, a lot of it's just we're able to measure it and we're aware of it. Just quickly moving to Europe, I think MiFID II, again, glass half full, I think it's going to be very beneficial potentially for ETFs. MiFID I did not include ETFs, for those of you who know. So looking at, again, what we take for granted here to have pre- and post-trade type of data in particular to really help show not only indications but the depth of liquidity in the underlying market. It's going to be super helpful. And we just, again, face all this tremendous fragmentation in Europe. It's not so much the multiple exchanges, it's really the clearing settlement systems and the plumbing, if you will, behind it. So we're not going to solve it all with, I think, kind of MiFID II, but I think certainly it's a step in the right direction, and who knows, maybe blockchain will get into the clearing settlement system and unblock that at some point. But I think overall, so again, I think they're kind of pluses and minuses, but I think what you are going to see overall is in financial services, they're going to be winners and losers. And I do think the degree, as I mentioned, that operating leverage and scale means that you're probably going to have bigger winners, kind of emerge out of it.
Well, I'll take that as a segue. You mentioned earlier as well about linkages between futures and forwards. Some of this regulatory stuff is touching the derivatives quite a bit. It's moving to exchanges, to central counterparty things. Like it's basically the plumbing that is getting affected. Any thoughts on that? And if it's too much in the weeds, feel free to pass on it. But I just thought that if it is, because you brought it up, like I'll pass on the opportunity.
So from my perspective, moving things onto exchanges is the right policy. It's a huge benefit to markets. What has to happen along the way, and it's only partially happened, is we have to rethink what are the risks of the clearing system. I think Eric Knoll mentioned earlier today, there's a lot of issues because of T+3 settlement with trapped capital that just have to be addressed. But that being said, moving everything onto an exchange system that's fully cleared in the shortest time possible reduces risk, and then you just have to worry about the solvency of your clearing system, which is a whole different problem.
Any thoughts on?
Just take a kind of a different. I mean, I think it is significant. I do agree with Ira that it's centralized clearing is generally better, certainly post 2008. What I would say though is a little bit concerning is what's happening in the collateral markets. And frankly, the lack of supply in collateral. And we're going to have in a couple of days pretty significant money.
Away from the U.S., not just the U.S., but,
I think global,
other global.
Absolutely global. I think we're going to, again, it's going to be a regulatory patchwork in different places. But I was just going to mention the money market reform, which is going to be official, I guess, on the 14th of October. If you really look, I think that's why for me, just at a macro level, you do see clearly the focus on Fed funds rate and overnight bank lending rates, still historically low. But then I see other especially the work on derivatives, the buying up of precious collateral by central banks globally. Those are very much tightening type policies underneath, this. So I don't think we just have kind of a lot of liquidity. I think we see liquidity coming out. So what does worry me is you think about centralized clearing and derivatives, something as large as foreign exchange next year. which is going to be tremendous, you need to have adequate, collateral, posted as you move to more centralized clearing. And I think that kind of supply is something we can't take for granted. And I think, again, you're going to see, we've already seen a lot of money moving because of the money market reform, but what is adequate collateral? How can we kind of manage that as the demand for derivatives is growing, even though it's going to be centrally cleared?
One thing that will be great, and the regulators are bringing us, is the consolidated audit trail. And so that's the kind of regulation. When we think about positive things, we think about investing in the infrastructure, we think about the plumbing. I think that's terrific. But gosh, that's going to be almost 20 years. It'll be more than 20 years since we've sort of realized we needed that. When did we realize that? Long-term capital, right? 1997, cross-collateralized every which way from Sunday. Nobody knew who had what. Oh, gee, I think we ought to have some sort of, audit trail for all this stuff. So it's taken us 20 years to get that. That's probably too long of time to wait for something that ought to be that basic, right? Sort of fundamental. So, but we're getting there, and that's going to be an improvement. So one of the great things, at least I think I've observed over the years, is we don't always get there as fast as we should, but we eventually get there. So every time we have a flash crash, we learn something, and we get better because of it. It's a tough way to learn, but at least we're making progress. I used to work for a guy who said, I don't really mind if it takes you a long time, just make sure you're moving in the right direction. I think that's probably not bad advice.
Sapna, any thoughts?
I agree with what these guys are saying. I think the one thing when we look at different asset classes and moving on to exchanges, I think the one thing to keep in mind is just lessons learned from other asset classes is always a good thing. Always comes up in the fixed income markets. Should we treat them like the equity markets? So it's just asset classes trade differently for a reason. You certainly want transparency. You certainly want a central repository to the extent that you can have one. But I just think that we should be careful in terms of how we go about doing it.
So there's two issues that it raises that I don't know that have been fully thought through, and certainly maybe are lagging the development itself. One is as you move things from OTC markets onto an exchange environment, there's more linkages between markets. And it's incumbent upon regulators to think more holistically and to understand linkages between these markets more than they might have otherwise. Certainly ETFs link everything to everything else nowadays, and that's a change from when I started. The other is, from a pure client experience, the fact that you're taking assets and exposures that have traditionally been regulated a certain way and reported a certain way and repackaging them causes tremendous issues for the clients. So think about an insurance company that invests in a treasury bond ETF. They have to report that as an equity, and they get charged capital as if it's an equity. It's not an equity, at least for purposes of risk. So I think there's a lot of work to be done as we think through what the ramifications are of these things.
Sure.
If I can, the other thing that happens, it seems to me, is you think about exchanges and more products moving on, and therefore we become more dependent on those institutions. They're interconnected. I think we all marveled when New York and NASDAQ agreed to sort of share backup responsibility for each other in terms of a closing auction, which I thought was great. But if you step back and think about the quest for speed, as we've been told, that quest for speed always removes support to the system, because support slows things down. It's redundant, it's bulky, that kind of thing, and they're trying to get lean. And so I get a little bit nervous when I think about becoming more dependent on exchanges, which is a good thing because it's transparent, we've got regulation around it. But I hope we're building the infrastructure because we're putting a lot more weight on that foundation.
That actually is where I was going in some ways, is that the panel brought up the idea of counterparty risk, and we saw counterparty risk get really big during the financial crisis. And especially when the counterparty risk is an institution like an exchange. But just generally, it's one of those things. It's like oxygen. Nobody notices it if it is there, and if it is missing, it creates a havoc. Have we have we addressed it? Is this counterparty risk, how do you feel about it in the post crisis world? Are we better now? Are we more?
I think we've reacted to it. I don't know if we've addressed it. Post-financial crisis, we found a lot of our buy-side customers actually looking at diversification. You don't want all your eggs in one basket. You want to make sure you're utilizing multiple broker-dealers.
Is this in terms of like prime brokerage relationships or
Yes,
something? Right.
exactly. So I think diversification was one thing that everyone looked at. And then the second is just being more careful about counterparty selection. You want to make sure you understand who you're dealing with and who you're interacting with. And I think you just think twice now.
So if I could paraphrase you, Sapna, there's a higher
bar.
sensitivity and need to know about who the counterparty is.
Yeah.
Yeah,
I mean,
it was interesting to see how
Yeah.
the people were running for the door with Deutsche Bank recently when that thing was announced. But yeah,
Well, it's interesting because, think about the lessons learned after 2008 and 9 in securities lending, where people thought there was really no risk. And now, you have people like us who are saying, okay, we're going to manage that collateral ourselves. So they bring it all in-house so that they know exactly what they own and they can market to exactly a market that they think they know. So again, I think you learn a lot when you go through these, but they're painful to go through. That's the problem with the learning process.
And it's certainly on people's minds. So I inevitably will have a client call me up and say, well, if I route you an order and you route to a dark pool and the dark pool goes down, who wears the risk?
Sure.
What about I interact with somebody else in that pool and that party goes insolvent, who wears the risk? So you get those questions all the time. So it's certainly at the forefront of a lot of folks' minds.
Ultimately it's trust, right? This is where the regulators are here to kind of force it, on you to some degree. But who you're dealing with has been said a couple of times is absolutely crucial. In pre-2008, there was this period of craziness that no one really knew ultimately who was accountable, and that's where kind of the fear in the system, kind of comes through. So I think to be able to, like I said, you have to put some regulations in place, but I also put back the fiduciary standards that are put across, people like us and others to really understand. Whether it's securities lending or, first of all, is it really beneficial to our clients? Sure. And I think securities lending is. It's been very helpful. But how much of that benefit, for example, at PowerShares, we give all the benefit, 100%, back to the clients. So it's important that we do. But if it's not applicable and helpful, we're not going to do that. But I would say in general too, I do think that looking at the banking system in particular, the U.S. has a very checkered history, from Alexander Hamilton to Andrew Jackson to the Fed. It's kind of these kind of global banking, which we've kind of imported from Europe to some degree. It's obviously had different implications. We have to again find our own way, I think, to get confidence, through that. But what we've had is not the dominance of banking lending, but the capital markets have thrived so much in the U.S. And I think if we can get back to that balance, what do we want our banks to do? But where do we really want, whether it's corporate bonds or equities? We do have a very, great history in kind of the capital markets and getting that balance.
It's a really interesting question to pose to someone. So how do you resolve an error? So when you have these relationships, as you talk about with people and things, and if they start moving around in their chair a little bit, well, I don't know if we ever really had an error, or I don't really know, it can't be us. And invariably in these conversations about routing and risk and other things, there's going to be a problem once in a while. So how transparent are people with that on the front end? And that's an interesting litmus test, I think.
I was just going to say, then you add like cybersecurity, that, again, it comes down to trust, but that's, you're dealing again with other vendors, third-party management. There's a whole amount of diligence that needs to be performed.
how do you feel, Ira? At BlackRock, you think there's much more sensitivity to counterparty now in the post than there used to be, or?
No, because BlackRock was always hypersensitive to risk. But as an institution, it was built as a risk manager before it became an asset manager. I would say counterparty risk and all various forms of risk are inherent in any kind of very interconnected system. It's never going to go away. It's incumbent upon people to understand the risks that they're taking and to take prudent risks. I think in the run-up to the financial crisis, people were taking some clearly imprudent risks and didn't fully understand them. hopefully we're in a period now where people have a better understanding of the risks and are being more prudent, but risk doesn't go away. It just, morphs into a different form, and who knows what the next one's going to look like.
Great. I think this is a great time to take a little pause. We would love to get some questions from the audience, give them a chance. We do want to keep the process on track, but I think we do have time for a few questions. So please, if there are any questions for.
Hi, this is Thea Knight from Cato again. So I just want to unpack this concept of risk a little bit more, because I was at the SIFMA annual conference recently, and I think there's a lot of concern about risk versus financial stability. And I think that post-crisis, a lot of risk has become this four-letter word, that the cause of the crisis was excess risk, whereas I think of risk as being unknowable, and the dynamism that exists when outcomes are unknowable, not that there isn't, that somebody hasn't done their due diligence. And so I guess my question is, are you as investors seeing adequate risk available? Looking at risk as the opportunity for upside, that if you're looking at something where I think that there's been a concern, at least from the regulatory standpoint, of we want to prevent too much risk taking, and to my mind, what that means is that we risk stagnation, and that there aren't enough, that the cost of risk is you're putting something at risk so that you can get a greater return. And we hear a lot of conversations about people looking for yield. So I'm just wondering, are you seeing stagnation? Are you seeing an appetite for that kind of risk, that sort of opportunity for return?
Well, active managers certainly are always trying to evaluate risk and return, and they are driven by valuation. And so if you do your work well, you identify reasonably priced securities where the return outweighs the risk. And often good investors think about the upside-downside case. And so that's our jobs, really. If you're asking, are we doing a good enough job evaluating bubbles and things that are out of balance, I'm sure we're not, because that's the nature of the business and business cycles. And so if you're an individual investor and you have an aggressive advisor trying to stretch for yield, my guess is you're going to get caught. Maybe not for a while, but at some point. And so, but that's always been the case. And so we're always, I think, trying to find that balance. I don't think this time is any different than any other. And after you have an experience like 08, 09, risk metrics kick in, and you probably put a blanket on it a little bit until people start to get more comfortable, and then they remove the blanket slowly, and then we get back to a period where you've got excess again. And it might not be excess in housing the way it was the last cycle. It might be excess in oil and gas drilling or something. I don't know what. Does that sort of answer the question?
I mean, my work focuses on financial regulation, so I'm always concerned about what the regulatory environment is doing to the markets. What I'm hearing from you is that in your answer, the fact that you didn't go straight to regulation means that you're not feeling that regulation is dampening the dynamism of the markets.
For me, just on balance, just to add to Andy's comments, I think that, again, you look at these kind of, like I said, demographics I talked about earlier, that's going to have a dampening impact, and that's not regulation. You think about the government, if you think about the social contracts we have in our pay-as-you-go entitlement systems, right? I mean, that was assumed in the 30s and subsequent decades that you're going to have, very steady population growth. When in fact, we have a very volatile, a huge, baby boomer population, pretty small Gen X, and then obviously going to be a very, very big, millennial. The crowding out impact that we may be expecting from kind of higher entitlement spending on deficits and what have you. I mean, all this is not necessarily regulated. I guess it is somewhat, but it's not something directly the regulation that we're talking about today. But then I think if you go back overall, Harry Markowitz talked about the closest thing investors can get to a free lunch is diversification. So we want high volatility. And I think if we can then find ways to obviously, but different asset classes or investments are differently correlated, using that volatility to our advantage. I think that's what we're after. So what I would say, not regulation, but perhaps monetary policy is really perhaps the biggest dampener we're facing now. And that's what's making it difficult where these low interest rates have pushed correlations very high. We can't get that free lunch as easily as we used to, but with many people hitting 65 and retiring, they still need the previous fixed income they had, which now is zero practically. Right. I have to move to equities. I have to move to more risky asset classes. So again, I would say that's more of a monetary phenomenon. I don't think you'd want to kind of mess with regulation around that. But again, there are different factors that do, I think, put kind of one hand almost behind our back. We're trying to help diversify, create income, particularly for an aging baby boomer segment. It does make it a very challenging environment.
So we could have one more question, one last question.
One quick question. Hi, this is Jenny from Georgetown. ETF gain increasing popularity, but part of the popularity is actually switched from derivative market to cash market. Overall, this is regarded as a positive thing, as people say, ETF can enhance market liquidity, facilitate price discovery. My question here is, from investors' viewpoint, what could be the potential risk or negative impact when people are switching from the traditional derivative underlying to the ETF market? Would any negative impact to the underlying, say, corporate bond fixed income market? Thanks.
Okay, so switching from derivatives to a cash instrument like ETFs. To be balanced, I assume there could be some negatives. My immediate thought is that obviously with a derivative instrument, whether it's a futures or even a swap, where you really don't need a cash outlay at the beginning, those are both fairly leveraged types of way of getting investment exposure. Obviously, in an ETF like equities, you can get a margin account. But I'd say almost a cash instrument, again, you're getting less of a leveraged impact with derivatives. You are getting well-established clearing settlement. So the transparency, I think it's, again, if you don't need the leverage, I think it's probably a good way to do that from the derivative markets. So, and then obviously moving away from particularly counterparty risk and even liquidity risk to some degree you may face in some degree. But what I would say beyond all of that is rather than looking at the instruments in competition, I think, ETFs, futures, swaps, other kind of Delta One products, even options, I guess, they really complement each other. So when we're looking at, we see a particular market, where the futures contract is doing really well, and that may be an instrument that institutional clients will use, we'll say, hey, maybe this ETF can really be, we'll do the same type of exposure, but we want to go after maybe more of a retail type of investor. And again, we know that our market makers, really find the benefit. They're able to hedge using those multiple instruments. So I would say kind of more is better, but I can't think anything that necessarily negative. I would just, again, I don't want to talk up ETFs too much, but obviously there are a lot of benefits of transparency and all that using an ETF versus a traditional derivative.
Yeah. All developments have side effects. So I would argue that the rise of ETFs is a hugely beneficial to markets. They're transparent. They deleverage the system. That being said, they do change the way things are done. So if you're a traditional bond dealer trying to make money by maintaining artificially high spreads, ETFs are a bad development. Is it a good thing or a bad thing if some bond dealers go out of business because they can't compete with the spreads of ETFs? I don't know. It depends on your perspective. I would say it's a good thing.
We want to keep things on track, so I am going to wrap up the panel. I want to thank the panelists for this great discussion. It was wonderful. Thank you very much.